Hello, I'm Marius Alexa. Welcome to this new edition of the weekly foreign exchange outlook here on JitneyTrade TV. JitneyTrade TV, the market information center of JitneyTrade. The idea I want to speak to you about today is the developing non-confirmation between oil prices and Canadian dollar. Obviously, the oil prices being the single most important piece of underlying fundamentals in the price of the Canadian dollar. I cannot help but notice that while oil just keeps collapsing to depths of despair, I think most of us would have labeled as insane only a couple of months ago. The Canadian dollar just doesn't seem to be willing to participate anymore. Now, obviously, all these kind of non-confirmation situations typically lead to market reversals. We have yet to wait for the final confirmations, but I think that the next several weeks, perhaps going into the year end, are going to be about some interesting market volatility that will lead to a good US dollar peak. As usual, let's have a look at some charts. Canadian dollar, our take on the pattern is that the sideways affair that started at the 130.30 area is not over. We're currently testing the high, and we should not trigger above 130.30, much less in conjunction with a trigger, in that daily RSI, because if that is happening, really, we will have a final run into the 133, 135 area prior to the peak. But as it stands now, provided we can hold below the previous high, it appears that the most interesting idea to play is a return inside the short-term range, typically within the 115, 117 area for now. Now, if we continue to forecast potentially developing Canadian dollar strength further down the road, I think, again, it's wise to look at what's happening in oil prices. And in oil prices, we see two things at the moment. Number one, in terms of market sentiment, the picture just got extremely dire. I mean, nobody's willing to hold on to the black gold anymore. And as a matter of fact, you will observe that, the open interest picture is actually turning pretty positive. We are falling into a market extreme of some type here. You would observe that, for instance, at the 2007-2008 peak, as we developed, that final fifth wave attack of the 140-150 area, commercials couldn't help but, just continue to sell on each and every wave of strength. They were basically net short at the time, and not only that they were net short, but they were actually a record short. Like an all-time extreme in commercial selling was developing, as the market was experiencing its final blow-off. And right now what we see is that for the first time in almost, a year and a half, 2 years, commercials are turning net long. This is exactly what they had done, if you will observe. Basically, the commercial positioning in the chart I'm showing aside is the blue line, and obviously the zero mark is where commercial positions would be even, longs would equal shorts, and obviously below zero we would have commercials net short, and above zero we would have commercials net long. And what is happening, you will see that a net long position is now visible, very much like it was the case when oil established the bottom near $50 a barrel at the beginning of 2007. So I would pay attention to this, because typically this group of traders gets it right more often than not, and because these developments actually happen on a weekly basis, not even on a daily basis, so it should be that much more relevant. Now, if we want to make the link between a potentially developing bottom in the oil, which I'm not telling you is going to happen necessarily right away. We can have a final wash into the $37, $40 a barrel area, but I'm telling you that, at some point in time, not very far away from where we currently stay, we will see a good tradable short-term low in the crude that will likely lead to a $30, $35 upside reversal, or uptrend bounce, if you wish. And if we are to talk really this dependence, I mean not this dependence, but this correlation between oil prices and the Canadian dollar, I have two charts to show you today. Observe, please, on a weekly basis in the crude and the Canadian dollar in the chart aside. The first quadrant would be the oil prices, and the second quadrant would be the USD CAD inverted, obviously to keep a direct correlation type of thing between the two quadrants. Basically what happened as oil was blasting off from $90 a barrel into the $150 a barrel, Canadian dollar just refused to participate. We had a pattern of new highs over a number of months in the oil, but no new highs at all in the in the Canadian dollar, no new lows in the USD CAD for that matter. And essentially, this Dow theory type non-confirmation led to a reversal in both markets, which once they both turned down, the Canadian dollar and the oil, the moves were pretty aggressive. As a matter of fact, we've seen, I'm sure you realize that we've seen a $100 collapse, in a very short 4 months following that 8-month non-confirmation type affair between oil and the Canadian dollar. And right now, I think we're seeing a similar picture, just at a lower degree of trend. Since about late October, the Canadian dollar has failed to confirm the continuing decline in crude oil, meaning that as oil prices continued to make new lows in the daily time frame, the Canadian dollar did not, for that matter, the USD CAD did not make any new highs. And I would dare to speculate today that this developing non-confirmation, we have yet, to get the trigger, the final confirmation in the direction of what we speculate right now, because both markets, like USD CAD, will have to drop back below 120, and oil will probably have to be back above the $55 a barrel mark. But I think that this developing non-confirmation, obviously in the opposite direction from the one we've seen at the July peak in the oil, will probably lead to a downside reversal in the US dollar, an upside reversal in the Canadian dollar, and to some type of, I would say, $30–$35 bounce at least in the oil. Keep in mind, Dow theory is, which is really where we take these concepts from, is basically where the theory from which the entire body of technical analysis evolved, and it basically started as a set of 6 tenets of key stock market behavior developed by Charles Dow at the turn of the 20th century, and in those 6 tenets, actually, Dow has put a lot of emphasis on the concept of confirmation, non-confirmation, which is extremely important throughout the entire body of technical analysis. Non-confirmation between related markets are extremely important. Non-confirmations in terms of momentum, market breadth, volume, and so forth are very important when one is trying to analyze the internal dynamics of one specific market. And it is our contention here that basically this developing in non-confirmation between the oil and Canadian dollar could be potentially very significant in the short term. So this is everything I had to say for today, folks. I'm going to wish you again, have fun, happy trading, and we'll obviously see you next week. Bye-bye now.